Well, thanks everybody for coming to this session on funding what matters, high growth firms. This is a little bit of a different format, so I'll start by just talking through a little bit what to expect. So we're going to start with what we're calling a scene setter conversation with our esteemed panelists, who I'll introduce in a moment, speaking a little bit about their experiences in terms of why they support high growth firms, and then what the lessons have been that they've learned in terms of supporting interventions to help firms grow. And then we're going to move, and this is why there are so many chairs here. This is not symbolic. We will have people in these chairs. To a series of what we're calling lightning talks by folks who are doing this day in, day out, getting their hands dirty, working with firms. So these are going to be 5-minute lightning talks. So by title, they will be snappy and electrifying. So looking forward to that. Each one followed by a very short, just kind of 1 or 2 questions. Great. So we'll go ahead and get started with the scene setter conversation. So I'm joined up here by Nicholas Koloff from the Argidius Foundation and James Foster from Gatsby Africa. And I'll turn it over to them for intros and add a little bit of a question to include in your introduction, which is, your foundations could be supporting anything. You could be supporting micro enterprises, which as we all know, make up the vast majority of enterprises in low and middle income countries. You could be supporting kind of macro level issues. So if you can talk a little bit about why you focus on these high growth firms through your foundation's work. Start with Nicholas.
So thanks very much. So I'm the director of Argidius, which is a private family foundation based in Switzerland. So why do we focus on growth firms? Because, to quote Esther de Flo, the best proxy indicator for somebody moving out of poverty is when they have salaried productive employment. And high growth firms and broader SMEs generate quality jobs. So that's what we're focused on. And if you look both at a personal level, but a community level, at an economy level, no country has made it out of low income status without seeing a proportion of its GDP from about 10–15% in small growing firms to about, as in my current home country, Switzerland, 40–45% GDP. So that's the shift you want to see happen. And we focused on 2 areas. So we focused on business development services, so the generic support the businesses need to grow, and on access to finance, how to create better pathways for financial access to those firms.
Great. So this is supposed to be an argument. So that's how it was pitched to me, that we have to be argumentative. So I'm going to do my best on that front. In terms of why Gatsby supports growth firms, I mean, we were part of the previous session, and our approach has evolved over the last 25 years from actually supporting microfinance and BDS services, supporting agricultural research, supporting venture capital establishment in East Africa and so on, to pulling it together to focus at a sectoral lens. And so we will, in a sector, we will look for high growth firms. We'll look for firms that we think can kickstart a new way of operating in a sector, demonstrate a new business model, or contribute to a sort of new way of thinking in an industry, maybe a new market, maybe a new set of products, whatever it might be. And so our focus is not actually on the growth firm itself, but on the wider system and the sector in which it situates, and trying to change that sector, that system, so that it grows more rapidly. So we're looking for the growth firm to do something that will help that to happen more broadly. So I suppose that's probably a key differentiator between us. I'll stop there.
Great. I'd love to get into kind of more specifics around the kind of at the practical level, the sorts of interventions you've funded and any lessons you've learned in terms of the types of interventions you found actually drive growth of firms, and then any types of interventions that you've experimented with or seen that have not been successful in terms of actually driving growth.
So when we started on this journey, which is now 13 years old, nobody knew whether business development services actually worked. So did accelerators accelerate? Nobody had any idea. So we thought we'd find out. So we found out. I won't bore you with the process about how we found out, but it took 5 or 6 years to get there. And you could begin to define the effective characteristics of business support. So if you think when we started getting $2 of incremental revenue from your business for every dollar you've spent on business development support was thought to be good. Last year across our portfolio, it was $16 per dollar spent. And there are organizations we work with who've got multiples of that. And that incremental revenue also translates into jobs. So you're getting multiples of 3 to 4 times the impact from those effective business development support. And that's true across the whole spectrum of enterprises from ideation to growth. So if you want to begin to create an ecosystem out of which firms emerge, good quality business development services are an essential piece of that ecosystem, and you know what good will look like. Because I can tell you, he says boldly, I can tell you what good looks like. And I can tell you across our whole portfolio, those organizations that have gone on a journey of consistent improvement and have maintained that impact over time. So that's a part of the ecosystem. And those firms that grow, which is a segue into James, is that we notice that 15% of those firms create 85% of the jobs. So out of that ecosystem emerge firms that have the capacity to grow significantly and create jobs at a significant rate. And some of them get clustered into sectors.
That is almost seamless. Yes, so from our side, I guess we think about it in 2 ways. One, I suppose, is indirect support to firms, which would be looking at the sort of sectoral ecosystem, perhaps supply of inputs, perhaps market access, policy regulatory changes and so on, that will unblock issues that firms are facing in a key sector. And then there's direct support to firms. And I guess we don't have a standard offer. We don't have a sort of, this is the product. We have a individual firm-based discussion around what are their current capabilities, where are they trying to get to, what do we see is needed in the industry, where's the industry trying to get to, and how can we bridge those 2 things. So whether that's helping to co-finance a sort of business viability assessment or a new product assessment or a new market assessment. Maybe it's just information essentially on that side of things. Maybe it's technical support to introduce a new technology and new ways of working, new processes into the business so they can be more profitable, productive, demonstrate a new thing. Maybe it's finance at times if there are other people in the ecosystem unwilling to finance. Victory Farms is a good example we talked about this morning, where it was a fish farming business of some scale, but banks locally hadn't seen such a thing before. And so they struggled to raise capital, and we were the only people willing to put money into a business that didn't have EBITDA positive or whatever. So at times finance is also perhaps something that we would do as a last resort. We don't see ourselves as a bank, essentially.
Great. I wanted to pick up the finance point and back to you, Nicholas. I mean, you talked a little bit about the business development service approach. Would love to hear a little bit more about your approach to supporting access to finance for firms, and in particular doing it in a way that is kind of additional, not distorting markets, using your grant capital in a way that's helping build those markets.
So if you ask me what really matters in terms of success, it's the single word is segmentation. So SMEs, growth firms are not a blob, but they're often treated as a blob. And So both with effective business development support, but also obviously effective financing, you have to segment your market. You have to understand which part of the SME market, growth firm market you're actually servicing. And so one of the things that we have done with commercial banks is to take them on that journey of understanding what is the market that hopefully they are incentivized by their own strategies to invest in and to understand that better. So one very concrete example was KCB, Kenya's commercial bank, largest bank in Kenya. It had, in 2017, over 1 million MSME clients, of which only 6% were tagged as business clients. The other 94% were private customers of the bank. So their SME portfolio in 2017 was technically $5 million. This is the largest commercial bank in Kenya, $5 million. Now, that was partly because of the misdescription, but it was also partly because they didn't understand the market. And when we started working with them, they thought they were going to enter a new market, but they actually already had the market. And they had the financial information on these businesses against which they could begin to design an effective product and begin to design effective processes, including relationship management, to be able to serve those customers. KCB's SME portfolio at the end of last year was $1.2 billion. And the vast majority of that money was on the balance sheet of KCB. African banks are not undercapitalized. What they lack is pathways to invest in this sector because they don't understand this sector, and they don't understand it because partly because they haven't segmented it appropriately and begun to understand which parts of it make sense for them as a bank. And so we've used philanthropic money to unlock that money. So we spent about 750,000 euro with the consultants supporting KCB on this journey. So 750,000 euros was turned into $1.1 billion. I'm not going to make the conversion, and which is not bad in terms of leverage. It's not bad in terms of leverage. And then we've packaged that process together with other commercial banks into a toolkit set of processes, which is called INVEST. We wanted to call it LEND, but we couldn't make the acronym work. So it's INVEST. And INVEST has now begun to be utilized by a number of multilateral development banks to rethink what is their technical assistance offering to banks. And one of the key parts is how to align that technical assistance with the internal strategic incentives of the bank. Because banks are like Boy Scouts or Girl Scouts. They collect technical assistance like Boy Scouts collect badges, basically. And because they do that, it's very difficult to understand the effectiveness of your technical assistance. So the first question is it strategically aligned with the bank, and why? And then you can begin intelligently to work with them.
Great, and that toolkit is available online, correct?
Yes.
All right. James, kind of on a similar theme. I mean, you mentioned before that you only do lending or investment as a last resort. How are you getting the finance in kind of indirectly, or what sources of finance are you seeing come in alongside of you in the cases where you don't have to provide that access to finance yourself?
So enormously variable. I guess it depends on the firm capability that you're dealing with, individual business. If it's for example, I'll take the forestry sector across East Africa. We've been working at multiple levels, looking at nurseries, looking at initial processes, looking at secondary processes, and then looking at the sort of building and construction industry. And so each one of those has a very different set of financing needs. The bank understands the commercial building industry super well. It doesn't understand forestry nurseries at all. And it doesn't really understand plantation forestry either. So in those two examples, we've had to sort of work with local banks to try and help them understand what financing of a sawmiller might look like, what financing of these things would look like, and also what the sort of process cycle is of a sort of forestry nursery. And as a result, we haven't had to put any money in ourselves, but we've got local finance, local working capital for nurseries sort of working. But again, that takes time and effort and sort of development of understanding in certain banks. But if you're working with a sort of slightly larger nursery, a sort of $10, $15 million a year turnover nursery, you don't need to get involved. Your finance is not needed. So I guess it very much differs. For Victory Farms, they've now raised a Series B and Series C, I think, investments of like 35 million plus another 40 million, I think, more recently. And they are flying from the DFI world and so on, and local working capital. But essentially, our loan had to be upfront was for working capital because they couldn't get that from a local bank. So yeah, it varies, different partners for different capabilities of business. Yeah.
Great. So you referenced earlier kind of getting into a bit of an argument, because I think you're both British guys who've been at private foundations supporting the private sector for 13 years. So I do think it's important to get into some differences here, and I do think it's a really interesting. There's a really interesting discussion here because both operating in the space supporting high growth firms, but coming from a little bit of a different lens. So the Argidius Foundation, as you referenced earlier, taking kind of a broad-based, non-sector approach, whereas Gatsby, as you referenced earlier, very deliberately picking sectors and going in. So I'd love to get into a little bit more of just kind of what you see as the pros and cons of those approaches and areas where they're maybe at odds versus potentially complementary. And maybe we can start with Nicholas, because I think we've heard a lot about the sector-specific approach today. So I'd love to hear a little bit more about the rationale for having the general approach.
Well, one of the kind of analogies is kind of education, in the sense that you have primary education, then you have secondary education, you have tertiary education, and it's like a pipeline. You create a space in which things emerge, and then people go in more specific directions or not as that proceeds. And so I think the two are complementary, they're not competing. I think that the two often don't talk effectively enough with each other. So I think that's certainly true. But just a very practical example, we have a accelerator program, investment program, very much focused on health tech related businesses in Africa. And they have successfully taken firms from ideation to fairly substantial several $1 million outfits. But there are significant sectoral challenges in the health sector: procurement, certification, cross-country certification, which they themselves, as an accelerator investor, cannot solve. And so there is a definite need for a sectoral approach to think about, well, this has become a cluster. This is becoming a sector. It's pushed against significant headwinds. What does a sectoral approach look like in removing some of those headwinds so that more of these firms can emerge, and they can emerge more quickly over time?
Again, you're telling the story of sectors for me, which is wonderful. I guess from our side, there are obvious risks of taking a sector approach, in that if the civil war breaks out in the area of your big industrial park you've been supporting, the industry collapses for a few years, perhaps. But more than that, if you choose a sector where there is political vested interest or challenges that are going to constrain the transformation you want to see, you might make incremental progress only. So clearly you're putting your eggs into a focused basket as such, and that then gives you risks in that perspective. I guess the benefit is that by understanding the sector in which a firm operates, you're able to really understand whether this firm is dynamic, competitive, has that sort of growth attitude and growth potential in terms of understanding the market, where they can go, where they can play, how they can expand. And I suppose through that understanding, you're then more able to tailor your support, tailor your product, tailor your your offer, I suppose, to that firm more specifically. And you can probably be more confident that your support is exactly or more appropriate to what's necessarily needed. So I guess those would be the sort of flip sides, right? You've got one positive and one, the opposite extreme is that it's a real challenge. And I guess if you sort of think through where does that lead you? It leads you to trying to sort of build a portfolio of firms in a sector that can collectively bring the sector forwards. So in forestry, operating at that nursery level, even at the sort of genetic species testing level, working with businesses to bring in new species and testing them for everybody, but at the same time working at the end of the value chain to try and build the demand for higher value forestry and timber and so on. So you can reduce the risk for a firm operating in that sector by having multiple sort of suite of interventions, if you like, with different businesses at different stages of the value chain. So I guess we would say that that's reducing the risk at the same time. There we go.
Great. Yes. Ended up in agreement, unfortunately. I was hoping for more fireworks up here. Final question, so to make sure we get to the lightning talks. I want to ask a little bit about the role of private philanthropy here. And I realize I didn't kind of introduce myself because this is near and dear to me. I'm the manager of the Growth Firms Alliance, which is a network of 5 private foundations working to support growth firms' ecosystems, Arcadius Foundation being one of them. So I think a lot about the role of kind of private foundations in this space. You know, your foundations are, in the scheme of things, relatively small amounts of money in the larger world, relative to bigger institutional sources of capital. So I'd love to hear, you know, how, first of all, what you wish these bigger sources of capital, like DFIs, MDBs, big donors, et cetera, did differently in this space. And any ways you've seen private philanthropy being effective in making that happen, in addition to kind of your direct interventions. Go back to Nicholas.
So, wish list. So what private philanthropic foundations can do is we should have extremely high risk appetites. But risk both in all the particular ventures we fund, but also the risk to actually articulate, hopefully, what we think actually works and doesn't work, and to encourage people to do more of what appears to work, and to stop doing things that don't work. So I've spent the last 10 years trying to kill the ILO's Start Your Own Business program because it doesn't work. It's very popular because you can train thousands and thousands of people to start their enterprises, almost all of which will fail, even if they don't start them. So it's very cheap, it's very cheerful, but it doesn't work. And finally...
Is it like a hustler fund?
It is a bit like a hustler fund, yes. Yes, exactly. And they've stopped. They now refer to it as a legacy activity. So they can't quite admit to doing it. So hopefully that's what we can do. We can take risk. We can experiment with things. We hopefully learn from things. We find out hopefully what other people are learning, and we bring that to the space. And so if I was going to kill something else, this is my wish list for killing things rather than for doing things, would be with the emphasis on youth enterprise. Now, I'm sorry, but if you're going to generate growth firms, they're not going to be generated by people under 30. All the evidence suggests they're generated by people in their 30s and 40s. 30s and 40s, unless you get lucky. 30s and 40s, and have had experience of working in large firms. So often they spin out of large firms to build those firms which grow and develop. And that will create the jobs for young people of quality. I know why they're popular, because again, you can get kind of scale, you get really enthusiastic about helping youth. You can find one or two things that have actually worked and get very excited about them. But on the whole, they don't. And so that's my next target, by the way. You know, So I get invited on panels to talk about youth enterprise, and I say, you do realize I'm going to tell you it doesn't work. At which point, mostly, I get disinvited. But there you go. But being a private philanthropy, you don't really care whether you get invited or not.
Great answer. Yeah, Nicholas's office is just a series of targets with different bullseyes in the middle, so watch out if you're in one of those. It's Nicholas's kill list.
I love it. I'm going to add one to the kill list.
Go for it. Yeah, James, what's on your kill list?
Which is sort of generic matching grant funds. So we had a lot of those across Africa, and invariably in the sectors where we operated, where we knew the different players in the industry, the matching grant fund would come in and fund the worst businesses who were negatively impacting on the rest of the industry. And so yeah, it was just deeply frustrating to see. So I would kill, mainly because they didn't understand the industry and where it was, and the competitive dynamics within it, and who was interested in what part of it, and so on. So actually, I would also kill those because I don't think they're particularly helpful. But in terms of what I would wish for on a more positive front, let me try. I mean, I think to a large extent, we are seeing a much greater degree of capital willing to take longer-term, more patient approaches, to invest in earlier stage businesses with less proven models. And I guess what we would love to see is more of that, more of the sort of less venture, but certainly pioneering capital that is able to meet the needs of firms that are coming in and trying to establish a new industry, a new sector. That's not like venture capital for sort of very, very fast-growing health tech firms. That's obviously needed as well, but that's not really where the big gap is, in our view. It's more in these sort of manufacturing sectors, getting money into businesses that are maybe trying to upgrade, trying to create a new product, trying to reach a new market, and are struggling to get money. So I think that would be great. And the most exciting pot of capital for that, as I see it, is pension funds and local institutional capital from the region, where there is a huge pot of money. At the moment, it is being spent on treasury bills because they're 14%, risk-free return. And so how the governments open up that source of capital for the private sector in a more deliberate way. And you see it in some places, and there are certain funds that are trying to do this, and there's interesting examples of where the people have been able to unlock some of that for other uses. So there's some exciting, I think, opportunity there. And I think that some of the lessons that the DFIs have been through in terms of getting themselves to be more concessional and targeted, I think would be really helpful for that. Thanks.
Yes, I very much agree with that. We've just Chigaba, which is a fund of funds for SMEs in West Africa, launches this week, and the 3 private investors are indeed pension funds in Ghana, and with the DFI, with the foundation, and with whatever FSD Africa is. Never quite sure how it describes itself, but anyway. I think, on a really positive note, I think what both philanthropy and development actors can think about is to think about blended finance as something that happens over time, not in space. By which I mean that you start using grant, highly concessional money to build the institutions, the models, the products, which then become commercially viable over time. I think we've got hung up with the thought that we should try to blend to attract commercial capital to things that are yet unproven from a commercial point of view, and it doesn't work that way. And the best historic example is financial inclusion, is microfinance, which began with grants, went to concessional, and is now a commercially viable investment space. But it happened in that sequence, not by trying to pull commercial money into spaces of high risk, which commercial money does not like. And I know that my own family that we work with, their principal activity now is private equity, and they will tell you we do not invest in things which are not proven. We like the fact that our philanthropic money is proving models because at some point we may want to invest in them. But it's that journey we need, not to try and do everything in the same space, trying to persuade money to do things it doesn't really want to do.
Somebody recently wrote a DevX article about that exact point. It was me. That's why I'm saying it. Coincidentally. How about that? Great. Well, I want to get to the lightning talk, so let's give Nicholas and James a round of applause, and the lightning talks folks can come up. I think if all of you can come up, and we'll just go down the line. I think right here. Yeah, we'll go this way, so you can go first, Josh. All right, so just in terms of this format, it's going to be a 5-minute talk going down the line, and we'll do 1 or 2 questions after each one. So as you hear each talk, think of some questions, and I'll we'll start with Josh Bicknell from Balloon Ventures.
Thanks, Matt. I'm another British guy who's been doing this for 13 years, so I'm not sure about how we ended up here, or you can make it that what you want. So I'm one of the co-founders of Balloon Ventures, and we are a regulated financial institution in East Africa. So we do lending to what we call real economy businesses, and I'm sure people will interpret that in different ways here. But for us, these are really the businesses that provide the critical goods and services in an economy. So we generally focus on rural areas. So in Uganda, I'd think about a clinic that needs a new X-ray machine, for example, to provide that service to the local population, or a school that's overcrowded that needs money to build a new classroom block, or an agri-input shop is coming into season, they need the latest seed varieties, they need wholesale financing or working capital for that. And so these are the kind of loans that we do, and it's not microfinance. And it was interesting, the discussion on banks, because our average loan is $25,000. Which is very much in the space in East Africa of what the banks would do, and it basically is just us and the banks that would be doing loans of those sizes. And I think what we see is that it's very, very difficult for banks to do that, and for a few reasons. I think there's 3. The first one is that these loans are pretty chunky, right? Like $25,000, you can lose a lot of money quite fast. And so it's hard to due diligence, and often it's just as much as a much bigger loan where you'd make a bigger return on it. And so it's hard to do because they're serious sizes. The second thing is that these SMEs, often they're very informal. So you've got an entrepreneur that has done well, they've grown a business, maybe they've now got 15 employees, but there's not really any processes or systems in that business, there's no financial record keeping, et cetera, et cetera. So if you just put in $25,000, it's more money than they'd ever had before in a loan, and chances are you'll probably lose that. And the third thing is, and I think this is almost the most critical piece, is you as a financial institution, you can't price what you can't measure. And if I look at Uganda and the SMEs that we fund, I'd say 90%, 95% of their transactions are cash. And in Kenya, which is often seen as very digitized, we see it still as kind of 50% cash, and actually that's going up because of government policy at the moment. So people that have tried to do these loans you often lose a lot. So that's the problem, and that's why it's so hard, and that's why there's so few institutions doing these kind of real SME loans. And so what do we do? So we do loans, obviously. So our average loan is $25,000. We go from $10,000 through to about $500,000. And ours is a volume model. So at the moment, we're doing about 50 loans a month. So we're not quite at KCB's $1 billion. But the idea is to do hundreds of loans a month and simplify it. But then there's 2 kind of key things in our product. So one, in our interest rate, we bundle in 6 months of business support that's all delivered in-house by our team. And so when we go into a business, we tranche the loan based on the business providing contracts of employment to all employees, for example. So you see contracted staff goes from 3% to 94% within 2 weeks, because money is actually a very good enabler of behavior change. So what we do with that, and also on the kind of financial management side, we'll put in simple systems so the business will start keeping financial records. And the point of that is to kind of materially lower the risk, right? So you actually get a better repayment rate because of what you do. And then the third thing is data. And going back to this idea of you can't price what you can't measure. So what we're trying to do is basically build a huge data set of what this kind of real economy cash businesses are doing. So we have systems now to kind of ingest the pre-investment, pen and paper records, receipts, any kind of bank statements they would have. And then at post-investment, we're providing all of this coaching support. We've got 22,000 hours of coaches' notes. So we've now got about 5.2 million data points on these SMEs. And so that's how we underwrite. So when a clinic comes to us, we know what the cash flows of a clinic are. We know what the margins are. We know what the seasonality is. So we're basically just comparing that against 200 other good businesses that we've loaned to. So that's kind of the key enabler in how we do things differently. And the same at post-investment and with AMI, it's interesting because we're kind of working on some similar things. But how do we kind of codify what good business support looks like? So now whenever one of our staff goes to a business, we have a kind of AI tool in your pocket. So you get a pre-meeting guide that tells you, of all the other 200 clinics, how is this one currently benchmarking? Let's say there was an issue, yesterday where a clinic was closed for licensing, you'll get that notification on your phone telling you that. So because our model is very much copy and paste, do the same loan again and again and again, you basically build up market intelligence, and that's how we do what we do. I don't know if I'm over my 5 minutes what I'm doing, but very quickly on impact. So what's interesting is if you look at our portfolio, 40% of those businesses have never had a business loan before, so they're unbanked. The other 60% are mostly, we call them underbanked, and our loan is on average 3 times bigger than the previous loan a bank would have given to them. So you can see how these businesses, even though they're cash-based, they actually can take on large loans. They're making a lot more money than what people think. And so once you have this data, you can do really, really good things with it. I think the other thing that's amazing about the kind of SME space is, we've done $30 million of loans. It's not a huge amount so far, to around 800 businesses. But if you look at those businesses, they're currently turning over about $500 million a year. In Eastern Uganda, that's equivalent to about 8% of GDP. The schools that we've funded, they currently educate 1% of Uganda's school children. The agri-SMEs that we've funded, they currently support about 3% of Uganda's smallholders. So it's quite amazing about, as I said, a small amount of money, the impact of these firms and the value chains that they sit within. And so just to wrap up, obviously I'm sitting here saying that Balloon Ventures is great and everyone should like us, but more broadly, what we're really saying here is that there's a product or an asset class or an approach, which is money plus support plus data. And that's what can unlock massive amounts of lending to these brick and mortar real economy SMEs. And we're kind of trying to prove that works, and we're trying to prove it in Uganda and Kenya and Tanzania, but that similar model with tweaks could work in many other markets. So hopefully I'm not over time. Thanks, Matt.
Interest rates.
Yeah, so we're a bank plus about 5%. So in Uganda, we're like 28%, banks are 24%. The biggest part of that is cost of capital. So our cost of capital is about 15%. So over half of our cost base is the capital that we raise. And I think that's the key part in all this is how do you make it affordable for these businesses with very, very thin margins? And that's all about the capital that you raise and the foreign exchange risk. At the moment, most of our money comes in US dollars, and we're kind of sitting on that. But I agree. I think that's the main part of our cost base and how you really get down to something that has a real impact in the business.
So you absorb the exchange risk yourself, basically?
Currently, yeah. Yeah.
Well, I have a question. I'm curious, in terms of at least my understanding of the literature on technical assistance is that even often when it's kind of been proven to be cost effective from the business's own perspective, it can be tough to generate demand, that a lot of entrepreneurs don't want it and don't see the value in paying for it, whether out of pocket or kind of bundled in implicitly. I'm curious the perception you've seen of the businesses of the kind of bundling of TA.
I think it depends. I think most businesses would rather a cheaper loan. And then there are some that as they do it, then start to see value in it. But for us, we basically force it through, right? So without the TA, I believe that we would have much bigger losses in our portfolio. So it's required to make these businesses viable. And then I think the rigor of charging it to businesses in the interest rate, and on the previous question about rates, makes you very brutal around what you actually do. Because if you do something that isn't valued, they're still paying for it. So when we started, we used to do a lot of kind of nice 5-year plans and strategies and lovely pitch decks and stuff, and it would be filed away and never ever looked at again. And and really entrepreneurs want something that can make them money fast or stop them losing money. And so I think over the years we've learned, we still focus on management and good management, specifically fixing financial management and HR, but how do you kind of package that in the language? And then, our retention rate is around 60% from loan 1 to loan 2. So I guess 6 out of 10 entrepreneurs like it, which is kind of what we feel is right for what we're doing.
Thanks so much, Josh. And now we'll move over to Naomi Karungo, for the marketing director from the African Management Institute.
Thanks, Matt. At the risk of not being invited again, they told us 5 minutes, guys, 5 minutes. So I wrote what I'm right. I wrote it down. So the year is the early 2000s, and my father was one of the biggest suppliers to Kenya's largest dairy processors. The business was growing and it was stable, and he was providing professional jobs to over 50 employees and supporting families beyond our own, right? And then policy changed. Kenya opened itself up to cheap milk extracts, and so overnight the price of milk just dropped to below the cost of production. And just like that, that business collapsed. This story is not unique, so I'm not saying it's like, oh, no. It's not unique. It's the story of millions of entrepreneurs in my continent that operate in business environments that are uncertain, they're exposed, they're highly vulnerable to economic, political, and climate shocks. But at the same time, we all know in this room that SMEs are not just a side story to Africa's economies, they are the drivers of Africa's economy. In fact, nearly 8 in 10 workers in the continent work for a small and medium-sized enterprise. And I just want us to take that in. So if you have 10 workers, 8 of those in the continent work for small and growing medium enterprises. And so the question for us as AMI became, how do we help these businesses to not just survive and become more resilient, but how do we help them to grow, to scale, so that they can create millions of jobs needed to absorb Africa's burgeoning population? And that's what the African Management Institute has spent the last 12 years working on. So we know that growth-oriented SMEs are the engines of Africa's economy, and we set out to design a business support approach that is practical, that is effective, and that's truly scalable. A couple of RCTs had shown that traditional microfinance, NGO-type training, despite being very widespread, was not effective. In fact, it had little to no impact on business growth. But we came across a really insightful study by Nicholas Bloom. Some of us might be aware about that found that firms that adopted better management practices grew. So those results came from typical coaching, consultancy type approaches, and we knew that that's not very scalable for our continent. So we also found another study by the World Bank in Togo around personal initiative, and apparently personal initiative and farm performance was beyond access to resources, but tied to entrepreneurs' mindset and their behaviors. So great initiative and resilience drive farm performance. And so what we did is we took what has been proven to work. That's the body of research from Nicholas Bloom on management practices, and then this stuff on personal initiative and resilience, and we built a scalable, affordable, practical business support approach for the continent, and that's how AMI was built. So what we do, we help entrepreneurs embed very specific research-backed management practices into their daily operations, while strengthening their own owner mindset. So building great initiative resilience that enables them to put those management practices to work. Almost done. So We deliver this through what we call a tech plus touch approach. So that's our online platform, and we layer in human support, and the results are clear. So we see 19 to 21% growth year on year on these farms, and for every dollar spent, we see a 10-time return on livelihoods. And our interim RCT results show statistically significant improvement in wages and job creation. So far, we've worked with 60,000 businesses across 39 African countries in the continent. And so we are demonstrating that an evidence-backed, scalable business support approach does work for the continent. What does the future look like in conclusion? The next step is scale for us. So we are building for the future. We're integrating this evidence that we have with our own AI model to improve our cost efficiency and to just deliver more personalized and scalable support. With partners like Ezra Charitable Trust and LIF that are in the room. We're also working with the Agidias Foundation. Also, Nicholas was here earlier, to take our methodology indirectly to other business development service providers. Basically, we don't want other business development service providers in the continent to reinvent the wheel. So we are enabling them to use this methodology, localize it, and embed an evidence approach that works for the continent. And we've seen this take hold. For example, in Uganda, we worked with the local government to develop national standards for SME support. In Kenya and Ghana, we are working with commercial banks to embed this support in how they support their portfolio SMEs. In Rwanda, we've worked with thousands of business support providers to equip them with our methodology, basically trying to build a community healthcare model for the government in Rwanda. So we don't have all the answers, but we have evidence, this golden standard of business development support. And this is the moment to help African entrepreneurs to rise beyond the shocks, to rise beyond their limitations and grow. And we invite you to be part of it. Thank you.
Great. Thank you so much, Naomi. Yeah, we can do a round of applause. So academics in the audience can be heartened by the fact that people take your papers and turn them into programs. Any questions from the audience before I...
So my name is Justice, and I work for the World Bank. It's refreshing to know that people outside the bank read our report, so it's good. I think sometimes we doubt that people read it, but it's good to know. My question is probably to the earlier speakers as well as to both of you. How do you really identify high growth firms in a data scarce environment? Because I think identifying these businesses is really important, right? But so far, from listening to you, it's not immediately clear to me what is the strategy that you use in identifying them. And also, we've learned that it's very difficult for even governments to identify these. So I would love to hear your take on this. Thanks.
Yeah, I think for me, just like Nicholas said, for us, segmentation is one of, first of all, the data didn't exist, and it's not like governments in, as an example, in India, for example, the SMEs have to report their sort of annual returns, and it's easier to find data than in Africa beyond tax, right? For us, segmentation, you can't identify if, first of all, you don't segment. So identifying those characteristics and then segmenting them and then pathwaying them to the right kind of support. I think the mistake a lot of programs do is like one size fits all, and you all are SMEs, we are all gonna give you this kind of support. So just getting really good at segmentation earlier on before programs, and then implementing the right kind of support and the support they say as SMEs that they want. Yeah.
Thanks. Yeah, let's do one more. Sure.
So I guess for us, the difference is, what are you trying to achieve with your support? And the support that we're talking about at this level is sort of incremental small business improvement. I guess our focus is not on that. Our focus is on transforming a sector. You heard the sort of 99,000 jobs created type numbers. We're aiming for much bigger than that. And I guess we're looking for creating productive jobs, productive employment at scale. And so for us, growth firms are those that can change the way a sector works, create a new business model that can, in the livestock sector, it act as a new secondary production model that means pastoralists can turn over their livestock much faster, beef production gets more productive, higher quality, etc. So you're sort of trying to change the way the industry operates in order to transform it. And I guess if we're aiming to sort of shift the economies of Africa from low income to upper middle income, our view is we've got to be aiming higher. And so, yes, all this is important and it's good to have, but it's not going to shift the structure of these economies, which is what we need to be talking about. Thanks.
So now we can have a row. No. No, because it's not either or. Because an entrepreneurial ecosystem will allow firms to emerge, and then you begin to potentially identify sectors and clusters, like my health suggestion. And then you can begin to work on, so what does the sector transformation mean in order to generate more of these going forward? So my analogy of education is a clear one. If there's no primary education, there won't be any tertiary education. And they're not the same thing, but they do lead into each other. And that's the important piece. The important piece is that you create that enabling environment, firms will emerge, and then you begin to ask yourself, okay, which sectors really matter? And then you can generate transformational change, but at the same time, the aggregate of small firms, so there is transformation, the aggregate of small firms is also really important because these are a large number of small firms. So if you've improved their ability to employ from 10 people to 30 people, and you've done that with thousands of businesses, then you've done something significant. And of course, you also have to remember that many of the small firms then become providers of service and support to larger firms. So this is an ecosystem that the sector is also creating as you go along. So it's both and.
Thanks. Great question and great responses. Let's move to David from INP.
Hi, everyone. I'm David Bunick from INP. And for the past 20 years, INP has been investing in African SMEs, supporting more than 350 companies, including 150 through equity investments. And I'll start with one number. Every month, 1 more million Africans enter the job market now and for the next 30 years. So the question is simple: where will the jobs come from? And our answer is as simple: partly from SMEs. Across the continent, including in fragile contexts, fragile countries, there are entrepreneurs building companies with the potential to grow, to scale, to create jobs. And what they lack is not talent, it's capital, and of course, the right kind of support. And at INP, we believe that equity investment is part of the solution. Why? Because equity is not only money, it's long-term risk sharing. So it's partnership, it's governance, and governance works. It's when the investors are close to the entrepreneurs that they can help identify bottlenecks, ask the right questions, and find solutions together. So the results, we have more structured processes, we have reliable financials, we have decision-making improved, and we have more formal jobs and better working conditions. And I can tell you, having met them, that there is no shortage of talented African entrepreneurs. But the real question is, how do we scale this model of equity investment? Especially now that the foreign aid is shrinking everywhere. So the answer is clear. We need to mobilize African capital for African businesses, which means more African investment teams, more African funds, and more African investors. And that's exactly what we've been building over the past 10 years with IPDev, not 12 yet, but 10. IPDev is a 20 million initiative, 20 million euro initiative that co-creates and sponsors African funds and African fund managers. So far, we've helped launch 9 local funds across countries like Senegal, Côte d'Ivoire, Uganda, Madagascar, Mali, Burkina Faso, Niger, and others, soon to be expanded further. And based on the money brought by IPDev into these funds, we also raised 2.5 times more from African investors, banks, insurance companies, mobile operators, corporates, individuals, public entities, sovereign funds. In total, about 25 million. Each of these funds is 6 to 8 million euros. And these funds are usually the first ones in their ecosystem, being local, and also the first one with the local governance this much. These funds invest small tickets, 250K on average, directly into these high growth potential SMEs. And here's what's important. These funds are local funds, locally domiciled, locally incorporated, managed by local teams, and often in local currency. Raising a local currency, they can invest in local currency. And this changes everything. It builds resilience, including to political shocks. It aligns incentives. It reduces the currency risk and the country risk. And even in challenging environments like Mali or Burkina Faso, these teams can continue to invest and support companies because they are local, they understand the context, they are committed for the long term. And since the shareholders and the teams are locally based, they continue to deploy capital as long as they can. And so far, there are 65 SMEs financed, 25% of average growth of sales, 2/3 of the businesses are profitable. 10,000 jobs supported, and several successful exits already. For instance, in Côte d'Ivoire, the partner fund of IPDev, called Comoé Capital, invested 7 years ago in Édition Vallès, which is a textbook publishing company. And at the time, the company had a yearly turnover of about 30K yearly. And today, the company has a turnover of above 6 million euros last year in 2025. Which is just one example, and of course, dozens of jobs supported by this company. But let's be clear, this is only a pilot. These funds are small. IPDev is almost fully deployed, and so now is the time to scale. We need to increase the size of this activity, double this model at least. We are currently conducting a fundraise for IPDev to double the size of IPDev, and these funds as well need to grow. We are already halfway on their journey for this fundraise. We are strongly backed by the European Commission, FMO, who are helping to reduce the risk through a first loss mechanism. And the ambition is clear. It's a network of 15 African funds, largely powered by African capital, African investors, financing the next generation of African entrepreneurs. That's how we can scale jobs. That's how we can build resilient economies. Thank you.
Question, let's start up front and see.
Thanks so much. I'm not sure who is best placed to answer this question, but in thinking about constraints to high growth firms, of course, there's no shortage of entrepreneurial spirit and efforts, but there is research on the shortage of middle managers and the high cost of middle managers as inhibiting growth of the modern sector in African countries. And I'm wondering, as you engage with businesses on the BDS they want, the money they want, if that's something, if support in finding and recruiting or connecting to middle managers or other types of experts that can provide that kind of support in new ways is something that's come up or that you've thought about. Thanks.
Maybe, David, if you have any thoughts on that from the IMP standpoint, and then, I mean, Naomi, you may have some thoughts as well.
Should we take several questions or just one?
Well, yeah, let's go, I think, in the green blouse, Charlene.
Okay, this is an IMP question. Okay, just to be intentionally controversial because it makes discussion more interesting. I think historically we've seen the traditional like 2 and 20 model for equity not work on the continent. I mean, that's a huge sweeping statement. So I'm just curious if it's hard enough for so-called like tech unicorns who are asset light fintechs, is it wise for us to expect that a traditional equity model would work for SMEs who already find it hard enough to scale? And have you tried any models or funded any funds that do non-traditional equity models like rev share or dividend payouts?
Great. So let's start, David. Alternative models to equity or pros and cons of different equity against different types of investment, and then any thoughts on the TA around middle management. And then Naomi, I think you can speak to the middle management as well.
Thank you for these questions that are very relevant. On the traditional versus non-traditional equity model, I think you're right. The ecosystem in general in Africa is different from ecosystem elsewhere. And the structure of the financing needs to adjust to the specific situations of the SMEs. And we do, and our colleagues, we use pref shares in some cases, we use sometimes dividends, we use some auto-liquidative instruments as well sometimes. So we certainly have to adjust some of the parameters, but I think these are only parameters. And I think the structure of the financing that's being brought to a company always needs to be adapted to the cash flows of the company, to the situation of the company. So that's really a tailor-made approach. And I think it should stay like this. And certainly the main parameter that we know for equity in Europe, in the US, could not directly apply. So we have to adjust the model partly, including in terms of cost. But we think that it's feasible to find a sustainable way to conduct this activity. And that's what we need to show now. On the middle management and management question, I think you are totally right. Usually the first time we meet with the entrepreneur, there is a very talented person, very good ideas, and he's usually, or she is, the most senior person. And around this person, limited level of skills, because the company is very, very young, and that's the situation. But there is certainly a lot of talent around, but we need to support, to grow this talent over time, and we need to help build the skills internally on the job. If people don't have the training from an academic background, they need to learn on the job, and we need to support this company in the journey towards the growth. But that's absolutely right, and we need to adjust to that as well.
Yeah, and then just to quickly add, when we are starting with segmentation, right, and for high growth firms, the entrepreneur capacity there is usually middle management. And middle management, of course, are like the engines of growth for those businesses. And often these people are first-time managers, don't have a lot of like management capacity. And so we use the same evidence approach and support them. And they also don't have time to leave their jobs and go learn and come back, right? So for our approach, we have action learning projects that help them still use this best practice, this evidence, and do it on the job. So instead of working on case studies, they're actually working on their business. And so that's a big component of our support for high growth firms. Yeah.
Great. Thanks so much for that. So let's go over to Elizabeth Brown, Executive Director of Building Markets.
Thanks, Matt. So I'm the executive director at Building Markets. We are a global network that connects small and medium-sized growing firms to buyers. So we are really looking at the problem and the challenge of market access that growth-oriented SMEs face. We work globally with regional hubs in the Middle East, Latin America, and Southeast Asia, and we have historically had a presence on the African continent through programs in Liberia and Mozambique. And we're excited to explore ways to re-engage and grow that presence again. We currently also have about 100 buyer businesses in our global network from both North and Central Africa. What 20 years of evidence building has taught our organization is that the challenges that SMEs face when it comes to market access is really not that dissimilar from geography to geography. And in order to build robust markets, like we've sort of talked about in this room, and I would echo what Nicholas has said, it's imperative that we not ignore SMEs, and we have to invest in building visible, capable, and capitalized small and medium firms to create supplier bases beneath these tier 1 large firms, some of which may also grow to become large with the right support. These are numbers we know. SMEs make up more than 90% of firms globally. They create more than 70% of the world's jobs. But what we're focused on solving for and unlocking is that to many buyers, largely in these markets, they're still largely invisible. This is reinforced by the way that supply chains are usually constructed. They're concentrated and very visible at the top, but they're deeply fragmented and opaque below the surface. So 71% of companies can't see beyond their direct suppliers, which means that buyers of different sizes usually default to known suppliers, and therefore high growth potential firms that could compete and could win don't get that opportunity because the cost of finding them, beginning to trust them, and transacting with them is still too high. Data, we talked a lot about data on small firms, in a lot of markets is fragmented or non-existent, and therefore then financing decisions that could be the difference between a small firm, if they do get offered a contract, accepting it or not, are too often based on perceived risk as opposed to opportunity. This is a problem that I would argue has been hiding in plain sight for years. Historically, overseas development assistance aid, which has dramatically been reduced, but only 3% of that historically has gone toward SME support, which is something most of in this room probably know. But of that, the vast majority goes toward access to finance and training programs. We would argue those programs matter deeply, but training and capital that doesn't lead to contracts and new business are incomplete interventions. If you skill up a firm and capitalize it, but it still can't find all of the right buyers and navigate procurement, that investment hasn't compounded yet. So for us, that missing piece is market access. This is what Building Markets does. We find qualified firms that buyers can't see. We build their capacity to compete, and we connect them to real market opportunities. In practice, this means we use verified supplier data, which we collect through robust surveys and resurveys of firms in our network. We use that to reduce and de-risk sourcing for buyers. We run procurement training programs that help firms begin to compete for formal contracts for the first time. And this year, we're excited to embark on using AI-enabled digital tools to begin to match buyers and suppliers across our networks, aiming to both reduce the cost of matchmaking and increase the scale of firms we can connect. Over the last 20 years, we've helped more than 28,000 small and medium-sized growing firms secure over $1.5 billion in contracts and capital, which has directly created more than 75 full-time equivalent jobs in the markets where we've worked. And for every dollar we've invested over the last 10 years, the firms in our network have generated $8 of revenue. Another reason we're so sold on market access as being an important intervention is that in our analysis of 5,000 firms in our network in the Middle East, having diverse market access routes, so beginning to combine digital sales, domestic procurement, export, has stood out as one of the strongest predictors of firm survival. So in the next 5 years, what we would like to see is market access baked into entrepreneur support programs and funded in a much more robust and diverse way through combinations of blended finance, working capital. I could talk a lot more about how important that is to bundle with procurement programs, and risk-tolerant philanthropical capital flowing to growing firms who've demonstrated they can deliver, but currently lack that liquidity to scale. And it looks like procurement opportunities in both the public and private marketplaces becoming more transparent and accessible through marketplaces like those that we run, where high growth firms can compete on credibility and transparency, not just through historic buyer connections. It also looks like women-owned businesses who currently win just 1% of global procurement dollars, increasing their share of that marketplace. We believe the capability is there, the demand is there. What's missing is the infrastructure to make markets work in a more inclusive way, but that infrastructure is buildable.
Thank you, Elizabeth. Great to hear about the organization. Would love to get a sense of maybe specific sectors or case studies of industries where you've seen this work really well, bringing the global demand in with some of these local businesses.
Yeah, that's a great question. I would say my answer is usually we're sector agnostic. It sort of depends on geography to geography. In Turkey and the Middle East, our sectors are really clustered around manufactured goods, consumer goods, textiles. So I would say the demand has kind of driven around the sectors that are prominent in that country. In Colombia, similarly, consumer packaged goods, leather goods, businesses that feed into the hospitality sector are very large in our network. And in Myanmar, I didn't talk much about that, but in Myanmar, we have a particular program that's focused on transformation in the recycling value chain. So we're really interested in sort of the transformation of plastic products and how you increase the productivity of firms working along that value chain. So we do take a bit of a sectoral approach from market to market as well. Yeah.
That's super helpful detail. Thanks. And let's go ahead to Marianne Ochola, Regional Managing Director of Endeavor Kenya.
So I'm Marianne Ochola. I lead Endeavor in Kenya. We're also a network, but a network of tech and tech-enabled founders. We're a global organization, and we have about 300 companies on the continent. We're sector agnostic precisely because we think technology introduces spillover effects across sectors, plus also, of course, diffusion of technology. So we just completed founder mapping, or a mapping of the Kenya entrepreneurial ecosystem. And this is the most recent and granular view of how the ecosystem connects and compounds. We spoke to 101 founders, and we also collected data on 700 companies. And what I wanted to share today is what we're learning and what we think that we should all be focusing on. In Kenya today, 15% of tech companies are employing 79% of the entire tech workforce. I think that's a data point that was shared by Nicholas today. But the thing I want to highlight is our entrepreneurial support ecosystem is not structured that way. It's structured for the 85% of the ecosystem that's creating 20% of the jobs. And that needs to change for us to transform the economy. The second thing we learned is that 82% of these companies are already exporting goods and services outside of Kenya. That is important because the highest salary, most senior jobs stay at home. We get foreign revenues in, and these companies are employing 50%. These companies are employing 50 people maximum, and once they hit number, they just keep growing. Again, that's a factor that's not factored in how we're building our entrepreneur support ecosystem. The other thing we're learning is that the game changer is time. It takes 10 years on average for a company to reach scale in Kenya. But when you look at the Kenya Startup Bill, for example, it's proposing that a company is only eligible for support up to 10 years. So when a company starts to generate these economic gains, it's when we say, okay, bye, you're on your own. And it's not just the policy environment, it's also when you look at our DFIs, our philanthropic capital, and how it's all structured in entrepreneur support, it's all early stage cohorts. But once you hit that 50 number in employees, you're successful. So that 10 years is where companies are struggling with policy uncertainty. They're navigating growth capital constraints. They now need to hire senior talent, but all the support has abandoned them. So we're working at that space as Endeavor, but we think a lot more of us need to be paying attention. So what's the secret sauce of our work? What we've learned is that it's not about companies. It's about founders. The energy for transforming our economies is in founders. And I'll give an example of a company called Cellulant in Kenya. It's one of the oldest fintechs in the ecosystem. It's been around for more than 17 years. 29 of Cellulant's alumni have gone on to found other high-growth companies. Ken Joroge, one of the co-founders, has invested his own personal money into 6 of these companies, and he's mentored many more. So Ken is what we call a multiplier. But that's a spillover effect that's rarely captured in our standard firm analysis, and it's rarely captured or even tolerated when we're designing policy. So we want to flag the founder as a node that keeps giving. Daniel Yu at the back founded Wasoko. He's no longer at Wasoko, but we can continue to track his impact to date because of the people that worked at Wasoko have gone on to found other companies. So Daniel is what we call a big bubble, and sorry for calling you out. It's just because I saw him in the audience. So I wanted to point out the role of the founder in ecosystem development. And this for us is the actual mechanism of how ecosystems becomes self-sustainable. And for us, an ecosystem worth funding is the one that can ultimately become self-sustainable. So the 2 things I want to leave you with today is how we reallocate public capital, how we reallocate concessional capital to focus on the 15% that are generating 79%, but to also think of the multiplier effect of founders as an investment thesis. Because you will not see in your grant report the 29 subsequent companies that came out of Cellulant, or the decades of trained engineers that will continue to work in companies, not just in Kenya, but also in Uganda, in Burundi, in Rwanda. That's the density of talent that comes out of focusing on high growth firms. So what does success look like? Success looks like not just asking the cheap and cheerful metrics that Nicholas was talking about, but it's asking how many of your companies actually reached scale? How many reached 50 employees? Not just how many companies, how many hours of training, no, how many actually reached scale? The second question I want us to live with is, what does ecosystem health look like? It's not number of companies. It is how many of these founders now have a platform to sit at a policy table and to define how that goes, or how many of these founders are able to become angel investors. What are the incentives for that? To become mentors for the next generation. Again, an ecosystem worth funding is the one that can be self-sustaining.
I love that. Maybe I'll be a big bubble for Halloween this year. That sounds fun. I know we're about out of time. Any questions for Marianne? Yeah, in the back.
Hi, thank you for the talk. Yeah, just to add to your point on the ecosystem, my first boss actually when I moved to Kenya was ex-Cellulant, so that's definitely proves out. But I was going to ask, you talked about kind of the bigger firms that are scaling up are the ones that need more support. And I definitely agree with you that kind of the big firms are the ones that are important and create the transformation. But how do you find the dynamics in how much they actually want help from their investors, how kind of open to it? Because they've already scaled to a certain scale, like they know how to run their business in many ways. How open are they to outside support? How useful do they think it is? And kind of how much are they asking for it?
So one of the things we've seen is a company continues to grow on that trajectory. Their problems change. But because we don't factor that in, we're still offering support that they needed earlier in their career. So at Endeavor, for example, 2 of the companies that we're supporting right now is one that has not been paid by the Kenyan government for the last 4 months. It's a very specific problem. It's not a cohort problem. It's just this one firm. And 4 months of unpaid invoices for a high growth firm is the difference between whether you'll be alive in 6 months. So for us as a network, it's leveraging government networks, people in high places, because that's how this works, right? And unlocking that. The other challenge is 2 co-founders who have reached the end of their partnership, and it's starting to affect the business. So now you want to bring in more seasoned founders who've been through that challenge to help them navigate, when co-founders fall out. My point is the challenges evolve, but the ecosystem does not evolve with the company. So at some point, they start not seeing the importance of some of these actors along their journey.
Great, thanks so much. I think, are we at time, or can we do another couple? Okay, I'll just quickly wrap up then. We've heard a lot about what high growth firms need, business development services, appropriate finance, market access. Behind it all is this web of networks. It's hard to do, but as you've heard, there are models that work. So I really suggest if you're interested in diving deeper with any of these models, talk to some of these folks. And the cage fight between sector-based and non-sector-based approaches will be at 7 o'clock tonight. So pick a side.